The balance sheet presents a snapshot of a company's financial position at a point in time. To improve users' understanding of a company's financial position, companies often use a classified balance sheet, which groups together similar assets and similar liabilities. It generally contains the following standard classifications: current assets, long-term investments, property, plant, and equipment, intangible assets, and then on our liabilities and stockholders' equity section, we'll show current liabilities, then long-term liabilities, and then lastly, stockholders' equity. Let's look at Franklin's balance sheet. We list our current assets first, followed by long-term investments, then property, plant, and equipment, and lastly, intangible assets. We'll talk about each of these classifications in detail. These groupings help financial statement readers determine such things as whether the company has enough assets to pay its debts. In the liabilities and stockholders' equity section of the balance sheet, the first grouping is current liabilities. Current liabilities are the debts and obligations that the company is to pay within the next year, whereas long-term liabilities are the debts and obligations that extend beyond 1 year. These groupings help financial statement readers determine such things as the claims of both short and long-term creditors on the company's assets. The last section is stockholders' equity. You will list common stock first, and then retained earnings. Current assets are assets that a company expects to convert to cash or use up within 1 year or its operating cycle, whichever is longer. For most businesses, the cutoff for classification is 1 year from the balance sheet date. Some companies use a period longer than 1 year to classify both assets and liabilities as current because they have an operating cycle longer than 1 year. The operating cycle of a company is the average time that it takes to purchase inventory, sell it on account, and then collect cash from customers. For most businesses, this cycle takes less than a year, so they use a 1-year cutoff. But for some businesses, such as an airplane manufacturer, this period may be longer than 1 year. We will assume that companies use 1 year to determine whether an asset or a liability is current or long-term. Common types of current assets are cash, short-term investments, accounts receivable, inventories, and prepaid expenses such as supplies and insurance. Franklin Corporation had current assets of $22,100. List current assets in the order in which they expect to convert them into cash or use up. So list cash first, followed by short-term investments, and then accounts receivable. If you are not sure of the order, please reference the chart of accounts, which list assets in this order. Long-term investments are generally investments in stocks and bonds of other companies that are normally held for more than 1 year. Long-term assets, such as land or buildings that a company is not currently using in its operating activities, is classified as a long-term investment. And lastly, long-term notes receivable would also be classified as a long-term investment. Franklin Corporation reported total long-term investments of $7,200 on its balance sheet. Long-term investments are often referred to as simply investments. Property, plant, and equipment are assets with relatively long useful lives that a company is currently using in operating the business. This category includes land, buildings, machinery and equipment, delivery equipment, as well as furniture. Depreciation allocates the cost of assets over its useful life. Companies assign a portion of an asset's cost as an expense each year, rather than expensing the full purchase price in the year of the purchase. To illustrate, let's assume a company purchases a truck that costs $60,000 and it has a useful life of 6 years. Let's also assume at the end of its useful life, it has no value. This company must recognize $10,000 in depreciation expense each year for the next 6 years. This truck will be used over time to generate revenue, so a part of its cost should be reported as an expense in the same period. The assets that the company depreciates are reported on the balance sheet at cost, less accumulated depreciation. The accumulated depreciation account shows the total amount of depreciation that the company has expensed during the asset's life. Franklin Corporation reported property, plant, and equipment of $29,000. Land cost $10,000, and the equipment cost $24,000, which was reduced by accumulated depreciation of $5,000 for a net book value of $19,000. Intangible assets are long-lived assets that do not have a physical substance. They are often very valuable. One significant intangible asset is goodwill. Others include patents, copyrights, and trademarks or trade names that give the company exclusive right of use for a specified period of time. If I show you this symbol, I would think most of you would automatically think McDonald's. Maybe some of you will take it a step further and you'll think of Quarter Pounder or Big Mac. If I show you this symbol, most of you will recognize it as Nike. In fact, some of you will take it even a step further and think of their slogan, "Just do it." Intangible assets are assets that do not have a physical substance, but are often very valuable. Franklin Corporation reported intangible assets of $3,100. Sometimes intangible assets are reported under a broader heading called Other Assets. Current liabilities are obligations that the company is to pay within the coming year or its operating cycle, whichever is longer. We said for purposes of this class, the cutoff for current liabilities will be 1 year. Common examples are accounts payable, salary and wages payable, notes payable, interest, and income taxes payable. Also included in this section are current maturities of long-term obligations. These are payments to be made within the next year on long-term debt. Franklin Corporation reported 5 different types of current liabilities for a total of $16,050. Users of financial statements look closely at the relationship between current assets and current liabilities. This relationship is important in evaluating a company's ability to pay obligations expected to be due within the year. When current assets exceed current liabilities, the likelihood for paying the liabilities is favorable. When the reverse is true, short-term creditors may not be paid. Long-term liabilities are obligations that a company expects to pay after 1 year. Liabilities in this category include bonds payable, mortgages payable, long-term notes payable, lease liabilities, as well as pension liabilities. Franklin Corporation reported long-term liabilities of $11,300. Stockholders' equity consists of common stock, which is the amount paid into the business by the owners for shares of stock, and retained earnings, which represents the earnings that are retained or reinvested in the business. Franklin Corporation reported total stockholders' equity of $34,050. This consists of $14,000 in common stock and $20,050 in retained earnings.